Sandip Sabharwal, the car was in fifth gear. It was in auto mode. Now suddenly it has hit a pause. What could be the next signal for this car to take off?
Actually, Nikunj, after you go to the fifth gear, the only way is down. So I think that's what is happening in the market. So I think
today now Sandip Sabharwal, SUVs are selling. There is sixth gear also in it. Turbo mode. The technology has changed.
then you buy automatic. Now most an automatic mode. Then market will always go up.
Okay, what could be the next signal now?
So I think there are 2-3 factors which are contributing to these corrections. One, obviously, is the unprecedented move. I wouldn't say unprecedented, the strong up move in the US dollar index. And that typically creates outflows into global emerging markets, and that's a phenomena we are seeing today. There are a lot of concerns regarding China and the decline in the Chinese economy and the yuan. A lot of foreign investors are exposed there, and I think that's having repercussions all over the world. Second factor is that obviously markets from 16,800 Nifty went up to as high as 20,000, 3,200 point move without any break sort of since the extreme pessimism of March. So that by itself creates a scenario where markets could correct 1,000, 1,200 points at least before markets come to any reasonable level for fresh buying. so I think to that extent, a normal correction also is a phenomena which is playing out. So I think if markets come down to 18,800, 19,000 levels, for people who want to allocate afresh, they could do that. Overall outlook for India still continues to be reasonably strong. There is some pressure on consumption demand, which is reflected in the results of many of the companies, which is being countered by lower input prices and improved margins. And on the investment side, the story continues to remain strong. So I think we can't be biased at all price levels. So as the markets give up some gains, then I think they'll present fresh opportunities.
Do you see that kind of 1,000, 1,200 point fall even from these current levels on the index?
Well, on the bank Nifty, there could be another correction, another leg of, I think, 700, 800 points. On the Nifty, I expect the index to, if in case the correction steepens, then I think maybe 19,000 at stretch could probably be the max downside. So which means another 400, 500 points on the GIFT Nifty if we try and do that, kind of math for the indices. But I don't expect too much of a sharp correction, because what's actually happened is that if the market gets into a sudden phase of correction, all sectors they start to fall sharply. But what has happened over the last 1.5 odd month, for example, the FMCG stocks, the indices, they corrected sharply first. The auto indexes, the auto indices, auto stocks, they had already gone to a correction much prior to when the index topped out on 20th of July 2023. So when you have such kind of leading corrections already in place for sectors, the correction for the indices, they tend to get halted at every 100 to 100 point kind of a zone for the index. So that's one of the major reasons why I would not expect too much of a sharp correction. But for weaker hands to get shaken out, you have to have a break of that strong psychological mark. So I think 90,000 could be the first strong psychological level, which could be retested in this leg of correction.
Right. The other stock which is going to be in focus this morning is going to be Nykaa, and we just flagged off a little while back the earnings disappointment and what the brokerages are now saying about Nykaa post that. So clearly, Bank of America has downgraded the stock now to a neutral after the Q1 miss. The target price has been cut further to 160 from the earlier 175. They're saying that it's a multiple cut from the earlier 15x to now 13x, and they're saying that the stock is fairly valued. The pace of margin is going to be slower going forward, and the downside risk remains if competition pressure increases. In fact, similar is the kind of commentary that you're seeing even from Macquarie as well. They retain their underperform. Target price has now been moved to 120 as well. Sandip, just wanted to your thoughts on Nykaa. I mean, as attractive as it may be at these current levels, but the problem is always going to be the competition that they have from the mighty bigwigs, the likes of the Reliance stable and even the Tatas.
Yeah, on one side there's competitive intensity. On the other side, there's a big opportunity because it's under-penetrated space. Unfortunately, Nykaa is also facing the issues related to what many of the other consumption companies are facing. That there is a pressure on consumption demand. They're having to push more in terms of getting sales in, which is impacting their margin. So the margin revival is getting pushed back. So I think that's a phenomena which continues now. We've also seen a series of top level exits at Nykaa. How that impacts the performance of the company, I'm not very sure. But I think that's also something which investors would be concerned about. Overall, uh, unlike many of the other uh, new generation companies which were listed, where there are some signs of turnaround and movement towards profitability, etc., that seems to be missing in Nykaa. So the probability that it will underperform for longer becomes bigger.
It's so ironical, Sandeep. Nykaa was right at the top of the pedestal because they had profits and they commanded a premium. While if I look at the business proposition for Nykaa, post-listing it has deteriorated, competition has intensified, the whole, in the way they handle that entire bonus issue, that has left a lot of bitter aftertaste for every investor. And if I compare Nykaa with a Zomato and a Paytm and a Policy Bazaar, they had fat losses and they are now walking on the path of profitability. So while Nykaa was the top of the pedestal, the business proposition has deteriorated, and for rest of the new tech space, I think it has only improved.
So I would say that other companies were in very deep losses. So I think they realized that they couldn't get more funding. So uh, they're sort of shaped up in the near term. However, the jury is still out on what Paytm or Policy Bazaar will be able to do longer term. Zomato was always in a duopoly, so it was all a question of when there is some discipline which comes in and they improve their P&L, and that seems to be happening.
ABB, and it's been an impressive quarterly set of earnings. But Sandeep, given that brokerages are still very gung-ho on the stock, saying that the scale benefits are yet to play out, is the road ahead for an ABB looking particularly impressive?
Yeah, I think ABB along. So I think that's a feature we've seen in many of the capital good companies that margins are expanded substantially as raw material input prices cool off and operating leverage plays out. And that's reflected in the way the stock prices have also behaved. The magnitude of outperformance of earnings is so great that it's helping these stocks sustain at the current levels. Otherwise, the valuations are not really cheap. So I would think that the probability of some consolidation rather than a significant up move, like today markets, obviously the stock might react positively, but the probability that many of these stocks would sort of stay there for some time before they begin a new up move is much greater than them continuing to rise higher because uh, they have outperformed so much vis-a-vis the overall market, and valuations are no longer cheap by any stretch of imagination.
What happens to Z now, Sandeep? I mean, looks like the decks are cleared for the merger to go through. If the merger will go through, the franchise value changes for the company. We've not heard anything from Sony which talks about a markdown in terms of the original valuation at which the merger was decided. If the decks are cleared, could Z be the stock of the year for rest of the months?
Because all of us know that the general entertainment space on satellite TV is a dying space in the sense that there are people who watch them, but have you seen a single youngster who watches cable TV or satellite TV? Any children who watch this? So it's a sort of dying industry. OTT is taking over clearly in this genre. So their ad revenues will keep on coming down. Their subscription revenues will keep on coming down. So I think it's a trading play. People who think that because of this merger they can make some trading gain, it's fine. I would look at it as an opportunity for people who got stuck in this stock. It's an opportunity to actually exit.
Off from the high. Okay.